Hey everyone, this is Les again. This is the second part of the video. Recession is almost certain. In this part, we're gonna talk about the economic cycles, so you can understand a little bit more about the economic cycles. What are the sectors that tends to outperform in different economic sectors? And finally, we're going to talk about the key indicators, key macroeconomic indicators that we normally use to take decisions on the stock market, to take decisions on our business, to take decisions on our long-term investment. In this case, real estate. If you're following us long enough, you know that we invest in property as a long-term and use trading to generate to grow cash during the short term and put the money back. So that's pretty much what we do. So and these all these decisions must be made based on our deep understanding of the economic cycles. So let's understand why I'm tipping for a major recession. Okay, so first of all, let's understand the cycles, the stages of the economy cycles, and how to apply into our investment. Okay, so essentially, this model shows that there are four phases on an economic cycle. The phase one, which is this expansion, phase two, the peak, phase three, the contraction, and phase four, the recovery. Understanding where we are sitting in the moment that you are trading or you are about to make an investment decision is critical to success. At BG Trading, we make our strategic trading and investment decisions mostly based on the BGS 20 strategy, but we also analyze the fundamentals and definitely the macroeconomics to ensure that if we are trading into the right sectors at the right time. So now let's talk about the sector. So how we can actually make better decisions in different cycles. First of all, let's identify which are the sectors that tend to outperform in different phases of the economic cycle. Now, I'm going to start with contraction, which is exactly where we are sitting at the moment. In contraction stage, normally the Federal Reserves and policymakers tend to decrease liquidity from the system, and then make things end up to become harder. Interest rates goes up, business struggles, and then that's exactly what's happening at the moment. So basically, we are in economic contraction at the moment, and during economic contraction, so the sectors that tend to outperform is healthcare, consumer staples, and utility. Why is that? First of all, in economic contraction, normally people will stop spending. They're only going to spend money into things that they really need, which in this case, healthcare, consumer staple stocks like Woolies, Coles, and utilities. And even say that that's the stage of the market that the whole market tends to take a major correction or even a crash sometimes. And when I'm talking outperforming, I'm still saying that we might see those stocks going down, but not as much as other sectors would go. Okay, then the next stage is the recovery. In the recovery stage, stocks that tend to do well is real estate and industrial, and that's because during the recovery stage, that's when the worst has just passed. The worst has just passed, and the economy is healing from that particular period, which the companies and the whole ecosystem was struggle to even survive in a lot of stages. Okay, then from the phase one, that bring us back to phase one, which is the expansion. Once we have the recovery phase, then there's expansion. The expansion phase is essentially when everything is going really well, and then there is this sort of interest rates going really low as well, and then that's when they start boosting stocks such as information, like tech stocks, financial stocks, communication stocks, and consumer discretionary stocks. So stocks like a Temple Webster, people are more people has the economy has gone through the recovery stage, and now there is a lot of money flowing into the economy, because normally at the expansion stage interest rates are very low. The economy has a lot of liquidity, people start spending a lot, buying cars, buying online, all sort of stocks like Temple Webster, that's we seen there during 2021, we saw stocks like Temple Webster, tech stocks, all sort of reaching all-time high. That's because the economy was super hot, and then that's when we should be looking into this stock after recovery phase. And then we have the peak phase, which is exactly where we been experiencing over the last 6 months, with most of energy, materials, and financial stocks going up. We saw iron ore stocks going rally really hard. We saw material stocks. We saw lithium stocks going really hard. And then now back to contraction phase. That's when those stocks start going down, and then we should be looking to shifting from that type of stocks to consumer staples, utility, and healthcare. So, or even sort of gold stocks. That's what we're looking as well. That doesn't say in this model, but gold stocks, it's an interesting sort of safe haven from contraction. Okay, the worst of the stock market should happen during the contraction phase, and that's what we're experiencing now. Now, why I think we're going to go to recession? To understand that, we need to go through some of the key macroeconomic indicators, understand those macroeconomic indicators, and obviously sharing the comments why each of those macroeconomic indicators are pointing for a major recession. Okay, the first indicator, and probably for us one of the most important, is the spread between 2 years and 10 years treasure, and there are this is a very important sort of indicator. Okay, now looking through historic data, as you can see here, we have the yield curve just inverted recently, and we have seen these sort of inversion levels since 80s. Since COVID financial, since global financial crisis. But what worries me here is that this inversion has been so steep, and if you look at here, every time it goes under zero, we have a recession following that sort of period. In this case, the contraction happened, and then we have this massive gray area here, which is exactly where the recession was. It's going to increase here. And then in 2000s, we have the tech bubble. We also have recession here, and you see how the 10-year treasure spread is sort of looking to here, just went to negative. And then again, we have the global financial crisis. And then finally in COVID. COVID wasn't that deep because it was very brief, but was enough to go really towards zero. But now, just last week, we have seen this thing going to negative levels, which we haven't seen before since the 1980s. This is unprecedented. Obviously, interest rates are increasing so much that it's highest interest rate increase in 30 years. So that makes completely sense. and then that brings short-term interest rates a lot more higher than long-term rates. So that's causing further deterioration on in the liquidity, and further deterioration and even sort of solvency in some cases. We just had this example of Silicon Valley Bank, not having short-term liquidity and going solvent. Obviously, Fed have stepped in, bailing out the bank, but unlike 2028, that was done at cost of taxpayers. At this time, Fed is only sort of financing the banks this time, which will comes with a bill later on. The whole idea of Fed stepping in and sort of avoiding this race to withdraw funds. The whole idea is to just to ease investors and ensure that people don't race as it happened last week with Silicon Valley Bank. So look, that shows there's a lot of uncertainty and doesn't give a lot of confidence as well for the short term. And at the end of the day, half of the analysts think that we might even see a decrease of interest rates in next week. Other half thinks that will be only 25 base points. But the truth is, nobody really knows what's happening at the moment. We could see a big surprise, maybe rates going down, but we don't know. And I'd rather not speculate on that particular sense, but rather use specific data to identify how weak the economy is at the moment. Another major indicator is the Purchase Management Index, PMI. So essentially, managers placing procurement orders across the board has remarkably decreased. Basically, companies are not ordering anything at the moment. They just hold the inventory, and that is another indicator that things are has accelerated its deterioration. So another indicator is consumer confidence. Consumer confidence, which is actually there's a little mistake here, guys. I had to fix it. Consumer confidence index has been falling since February, January and February, and that also highlights the fact that economy is continuing to deteriorate. Okay, another indicator is the new U.S. Corporate security issues as well. So normally when the economy is sort of in recovery or expansion, especially in expansion phase, we see a lot of companies issuing new shares as a result of expanding business, investing further, a lot of acquisitions happening, and that is a key indicator that economy is healthy and it's growing. In this case, is exactly the opposite happening. The number of security issues are decreasing on a monthly basis, and that also shows the significant increase on new U.S. Corporate securities. It's a big warning sign that a recession could be following in a very near term. Okay, so so when is the next big thing? When's the next rally? That's my question for you. So now, because the Federal Reserve monetary policy has been the tightest since 1980s, the majority of world economy is now in a severe contraction. As I just said before, far worse than it most of analysts has foreseen in 2020. Even ourselves, we haven't foreseen that after this problem with Silicon Valley Bank. So during severe economic contraction, the U.S. market tends to underperform okay, the stock market tends to underperform, not to say a crash in some stage, in bear mode, okay? So, which is exactly what's happening now. In the 1980s, what happened is, in GFC, we saw a significant decline in equities during the pivot of interest rates hikes. So we saw in both events a major decline, okay? And that's why I'm suggesting that we're gonna see a further downside on the stock market. That's because those macroeconomic indicators are pointing so. Not because I think, but because those macroeconomics are pointing so. And all we have is data to make decisions. Okay, so that's why I'm very careful at the moment. I'm holding very few stocks. I'm holding gold stocks together with some of VIP members, but majority of my funds is at the moment in cash. And I want to see what's happening. I want to see how next week's FOMC meeting will come up with, whether whether Fed are going to increase only 25 points. We don't know exactly what's going to happen, but that is going to be critical to give us the direction, the new direction towards the next month. So, guys, hope you that makes sense. Okay, so major recession, potentially further decline, not to say crash. It's on the cards. So be careful. Make sure you protect, because once we have a major decline, then we're going to have the opportunities, and that is exactly what we're going to be focused on, the next biggest opportunity. Okay, the worse it gets, the best is the opportunity. Thank you very much. I'll see you in the next video. The whole idea when we designed BG Trading BGS20 strategy was to use only a set number of indicators, to make it simple and clear to understand, and to be able to apply our KPIs very easily and very effectively. So you don't have to be any Wall Street smart person to be able to apply those strategies. We really hope this course will help you to make better decisions and make successful trades. See you in the course.